It's my pleasure to bring in Market Chameleon's Dimitri Pragmatic to this webinar today. Hey, Dimitri, how are you?
Good. Thanks, Jeff. Thanks for having us.
I love having you guys come in for our monthly webinar, which for everyone's information always takes place the second Tuesday of the month. And then you guys, I know Will wasn't able to make this, but he's going to be popping in with you later at the ibkr podcast studio to record a podcast on the same subject. You know, I wouldn't say a deeper dive, maybe a little bit of a different dive. So definitely if you're interested in credit put spreads, which you guys are going to be talking about today, definitely podcast should be coming out in a couple days, and you can find that on our website under education with all the other great material that Market Chameleon collaborates with us.
Thank you, Jeff. And let me just quickly, I'm going to scroll down to the disclosure, give the audience a chance to read over it. And while we're doing that, what we're going to do is quickly go through a slide to talk about credit put spreads and screening for credit put spreads. It's like an overview. Then we're going to go and look at some real examples. We're going to do some screens and talk about some of the metrics and you know what we've screened out. And then we're going to leave like 20 minutes at the end for questions. So we're just going to take questions from the audience, and Jeff, you'll let me know when those questions come in and read them back to me, but you guys can put them in on that chat.
Yeah, absolutely. And a couple of things for everyone. There is a copy of Dimitri's PowerPoint presentation under handouts. It's always a good resource guide. If you want to grab that, you just kind of click on it and you can save it to your own computer. Also, I know this question always comes up a lot for you guys, Dimitri. If you this webinar is recorded, so if you signed up for it and have to leave midway through, or if you signed up for it and something came up and you couldn't make it live, a link will be sent toward the end of the day in a couple hours, and you'll be able to go onto it and have access to it. Also, even if you have friends that didn't sign up for this, they forgot to or whatever, all the past webinars are available on our website, ibkr.com. Go to education, go to webinars. It says like past webinars or previously aired webinars or whatever, but you can always find all the great stuff that Market Chameleon has contributed, as well as our other collaborators as well. And I think on that point, and then again, like, oh, I see, I'm going to read a question that I'm saving at the end. Peggy's asked, how's access to handouts? There should be a area on the bar that says handouts, and the PowerPoint presentation is there. There should be, all right, Dimitri, on that note, I will let you take it away.
Yep, thanks. So what we're going to do today, we're talking about screening for credit put spreads. And really the goal is just to show how traders can use these tools to conduct research, to screen and analyze credit put spreads more efficiently. And for those of you who don't know, what is a credit put spread? Well, it's a strategy. It involves two options. You're selling a put with a higher strike and buying another put with a lower strike on the same expiration. And it's a bullish option strategy with a predefined risk, which allows you to limit your max loss, but it also caps your profits. Now, why would you use credit put spreads as a trader? Again, you would have to have a bullish outlook, but you want to have some predefined risk when you're using, an option strategy. People use it sometimes because they're looking to generate premium or option income, especially if your outlook is if the stock is bullish or maybe stays flat. And you could even structure it if it dips slightly based on the strikes that you choose. And it's also lower margin requirements than just like selling a naked put by itself. which gives you an unlimited risk down to the stock going to zero. Now, the other benefits is that the strategy does give you the flexibility by choosing strikes. So, like for example, if you did a put where you let's say sold an at the money put and bought a strike beneath, well, there you're trying to collect a higher premium, so there's a higher potential payoff, but there's more risk because than an out of the money, because if the stock goes down below the strike, that put spread will be in money. You could also choose an out of the money put spread with lower strikes. You're selling a lower strike and buying a strike beneath there. You're going to collect less premium, but this gives you a bigger cushion, because if you're out of the money, the stock could go down, to the point where you're shorter strike, and that put spread would still be profitable. So there's a little bit of a trade-off there, but gives you that type of flexibility. And when we're going to talk about the put spreads, as traders, we look at certain metrics and benchmarks and ratios and so forth to help us make evaluations and help us make better, more informed decisions. Part of it is, when the ones we're going to look at is, well, we have this market price, so we know where you could buy or sell something, and you want to compare it to for an evaluation to some benchmarks. We're going to look at historical benchmarks to see how far a historical benchmark for a similar spread that was valued and how far they deviate. We could look at also historical win rates, and these are looking at a spread and then making an evaluation or estimate the probability of the success of this spread based on historical stock moves. Okay, so we're using kind of history as a guidance to make an evaluation of market prices. We could also look at potential payoff scenarios tied to different stock reactions, and we could also look at things like, how much cushion does this spread offer us, or downside protection in case the stock does not go in a bullish manner. If it doesn't go up, is there any cushion in the strategy if it happens to go the other way? Also, so when we're using the put spread screener, we could, if we have these metrics in our screener already built in and those calculations are made, then we could start to screen or sort by what we'll call it an edge, or the difference between the market price and the historical value. So it's like a theoretical edge. We could also screen by theoretical win rates, or the probability estimates of probabilities of success. We could also screen or sort by the cushion we have, or the different payoffs that we estimate based on the stock moves. So one standard deviation down, on one standard deviation up, if it's unchanged, 3 standard deviations, and so forth. Historical data also can be valuable in our overall analysis, right? Because this allows us to take the specific underlying, use the historical data, and we could then run an analysis on actual data to help create estimates or evaluate the current spreads. It also allows us to use actual data to help us try to map out potential risks and rewards, max payoffs and losses. We could apply the historical stock moves to estimate success rates. And it helps us to quickly create benchmarks, to see if the spread is overpriced or underpriced based on those historical benchmarks that we generate. So, you know, we could also just, if we wanted to create visuals, but these are quick reference points to evaluate market prices. Because if you have market prices and that's all you're looking at, it's hard to determine, well, is this on the higher end or lower end of the historical range? You know, how do you know? You know, well, here's a put spread, $3. Well, for this stock, is that an expensive or relatively inexpensive price or valuation for this spread? Well, we need some kind of benchmarks to help us along. In addition, when we look at options, we know that there are other factors that play into it that could impact, you know, the premiums of options, the volatility, such as, you know, upcoming events like earnings, news, dividends could play a factor in it. And if we know of certain upcoming events and we're in the screener, we could even filter for that to see how those valuations and events are, you know, compensated for. We could add other things to our, as you will see, to our overall screener. We could add stock analysis, right? So technical analysis will include how the stock behaved. We could see what's the current trend in the stock. Is it in an uptrend? Is it in a downtrend? Is it, you know, bouncing around? So we could look at the stock and technical analysis to help us along the way in our decision-making process, how we should, you know, evaluate the options. We could, you know, look at our theoretical support and resistance levels based on different metrics that we use to evaluate that stock. And this helps us refine our candidates further. So the benefits of using this screener is that we could quickly narrow down candidates. We could customize filters and use our unique metrics, and we gain faster, quicker insights into the potential risk and reward and probabilities before, you know, digging in further or committing to any strategy or trade. And always to remember, options carry risks. So there's nothing about a screener or a specific metric or analytic that, you know, takes away the risk. There's always risk. Those are just helping us guide our decisions, but options will always carry risk. There's a risk assets, risk instruments. The screeners, they'll help us with our research, right? It doesn't eliminate that market risk of volatility and news and other things that, because markets are dynamic. And what we're going to do now is look at example screens. So we're going to walk through some sample screens for credit put spreads. We'll show, you know, choosing strikes, expirations, payoff diagrams. So we'll just go over some different ways to look at credit put spreads and do some example screens, and then we'll just take questions afterwards. Okay, so I'm gonna go now to a screener, and this is the credit put spread screener. And the thing with the screener is we have filters up here. We have different tabs. Okay, and then we have the data analytics below. All right, and those data analytics, we also have different tabs showing us different data. So I'm going to start here with the summary, and just like reading it from left to right, you see we have over 24,000 different potential credit put spreads in this table, and by default it is you need an expiration. So here we started out with the nearest monthly expiration, which is October 17th. But if we go down here, we have different ways to select it, different expirations, or we could actually look at all the expirations expiring within the next 30 days. But let's stick with October 17th for now. And we also defined where we're looking for spreads with the max of difference between the strikes of $5. Okay, so it could be $1 spread, $2, max of $5, just to narrow down initially the potential items that we're analyzing. So you could see here that there's a bunch already in NVIDIA. This is sorted by highest market cap. So, NVIDIA has a bunch here. And we know this is October 17th, and these are the individual strikes. So selling a 197.5 put, buying the 195 put. This one's selling the 197.5 put, buying the 192.5 put. So you could see there are lots of different strike combinations in a put spread. And you're selling one, buying another, right? So you could sell, for example, 197.5 put and buy the 195, or sell the 197.5 put, buy the 92.5, and so forth. So lots of different combinations in these different put spreads. And over here, just for convenience, we showed the max loss based on the current price. So if the market price is 235, if you're selling it, and the spread is $2.50. So if you're selling it for 235 and you're in the max, it could be worth is 2.5 at expiration, and you're buying it for 2.5, you're losing 15 cents, right? You sell for 235, but you're buying it back for 250, you're losing. So that's what it is here. The cushion here, like for example here, shows you that, for example, in NVIDIA, if you're selling the 182.5 and buying the 177.5, well, as long as the stock stays above 182.5, if you sell this for $1.53, this is the credit. You keep the credit. Both puts would expire worthless. Right? If the stock's above 182.5, both stocks expire worthless. Well, since the stock's already above 182.5, right? Even if the stock sits here, both these options will expire worthless at expiration, and you keep the entire credit that you sold it for. And it could go down a little bit, right? Because we're already above there. So that's what this cushion is to your break even. You have about 1.2% to the downside before you hit break even. Below that, you start losing. So if you stay here, go higher, you're good. And you have a little bit of a cushion. And for convenience, this over here tells us the return if the stock is flat. So let's say the stock does sit here at 183.23. Well, if you keep everything that you sold it for $1.53, and your amount at risk is 347, well, that's a 44% return on the amount you had at risk. Okay, so that's what it is, saying, well, the stock stays flat here, and from here to the next expiration, which is a couple of days away, that's a 44% return on the amount you have at risk. All right, and we could sort by these or even screen by these. Another thing I just wanted to show you here, these are the market prices, right? So these are the market prices of the corresponding spreads. And remember, we talked about theoretical values. We talked about, like, well, what did we think in theory this spread is worth based on how the stock moved previously? Right? So if we took the historical return distributions and calculated based on that, then these would be the theoretical average prices. Right? And you could open the analysis, and it kind of goes through analysis in here. All right. So what this does is help us quickly assess where are we, where's the current spread price relative to how the stock has moved historically given the similar circumstances. So, if this is, for example, 3 trading days away, the stock price is a certain percentage away, based on the historical stock moves over here. We calculated theoretical values and took the average of it. So now we could compare a benchmark to the market value. So if you're selling above a benchmark, right, you would want that, right? You would want to sell it for higher. So if you're a seller, you want to sell it for the highest possible price. If you're a buyer, you want to buy it for the lowest possible price. So if you're selling above the benchmark, in theory, if that benchmark resembles anything, the distributions going forward, then it's like a theoretical edge. You're selling above. So that's what this is. In addition, what are these win rates? Well, the win rates are looking at the historical stock moves and saying, okay, if we applied the historical moves, some were down, some were up, some were unchanged, some were up 5%, some were up 1%. So we took all of those in the 3-day range and we said, given that, out of those moves, right, how many of those moves moved to make this spread profitable right now, right? So that's what we want to see is the frequency. Is this, if we sold this, is this historically, showed high probabilities of win rates, low probabilities, how frequently. So this is showing us it's 23.2%. So 23.2% of the historical moves would have resulted in this being profitable. So you could see here, the stock is at 183.23, and we're below that 190, 195. So it has to increase by a decent amount in the next 3 days, right, for this spread to be profitable. Because if it's below 190, the spread's worth $5, right? So that happened 23.2% of the time on a historical basis. Okay. So we have all these metrics now to help us along. Now, in addition to that, so we could start, for example, we could just start screening by that. Let's just say we wanted to see a high theoretical edge. We could say, well, show me something with 5% edge. So then these are all 5%. If we wanted to see high win rates, we could look at, if that's important to us, we could look at, above 80%. So then you get, 80% with 5% edge. So you get a different candidates in here. If I release these and just said, well, just show me the best, in NVIDIA, let's just say, or any stock, just show me the best one based on something, right? So based on theoretical edge, win rate, the return if the stock is flat. So we could just say, show me best theoretical edge. So this will go on October 17th, and it'll say, okay, in NVIDIA, this one has the best theoretical edge. Microsoft, there aren't any positives, so this is the best one. And Apple, it's this. So this will list us each of the spreads in October 17th by these theoretical edge. If we wanted to do it by, for example, if the stock is flat. So we come back here. We say that return stock is flat. So here in NVIDIA, this will be a 50% return if the stock is flat, remains at the same price at its, at expiration. For Microsoft, it's 47.1% return the stock remains at 154.14, right? Because that will be above this spread. So as you can see, that what this screener does is it allows us to quickly narrow down potential candidates to go and research further by these unique criteria. All right, we could combine them as well. So I'm gonna let this go for a second. So sometimes as traders, we also want to see things that are trading in the market. So this is looking at the markets. But let's go to the volume. I'm going to go, remember we have these tabs. I'm going to go to the volume. And based on this volume analysis, if we go from left to right, this is the volume on each leg. You know, on the volume on the strike for the buying volume. These are the open interest. This is the volume on the sell side. So this shows us just the volume on each of those contracts. But sometimes these spreads actually trade, right? So there are multi-leg trades where people actually might be trading these particular spreads. And that's over here. Based on today's multi-leg trades, this particular spread, the October 17th, 190, 195 put spread, it actually traded 3 times today for total contracts of the 42 contracts, okay? And the weighted average price of all of them was $4.48, and the weighted average bid and offers $430, with the price of the stock at 180, 149. So this helps us further to see maybe not only are we looking for, in theory, what we think the price or based on historical evaluations, right, benchmarks, we could see where the prices are trading in the market themselves. So let's just say, I'm going to sort this column, right? Let's do it by volume. So we're going to look at the biggest volumes. So here's one, over 17,000 contracts in FHN. Here's SP. Here's an SPY. It's BIQQ. So all these different Amazon. But here's 17,000 contracts, and we could see that the last time it traded 7 times. Last time at 1:38 p.m. 30 seconds. The average weighted price is 52 cents, with the bid 40 cents, 55 cents. So what this quickly lets us know is, well, there's liquidity in this particular spread. Traded a lot. You know, there's definitely interest in the spread. It also indicates to us that it traded closer to the ask price, right? So 40-cent bid, but it traded closer to the ask price, 52 cents versus 55. And why is that important? Well, if we're trading something and we're looking for execution, right, for better quality execution, well, you know, this helps us now see where, relative to the bids and offers, things are trading and where we could place it. So, for example, if I sold this for 40 cents, let's say, right, just hit the bid, or if perhaps instead of selling, I try to maybe offer it, you know, close to the ask to see if I could execute it. 51 cents, 52 cents. Well, that percentage-wise is a big difference, right? When you think about it in terms of percentages, you know, 52 cents and 40 cents is, you know, something like 30%. You know, like, so it's a 30% execution cost. So think how difficult it would be to make up a 30%, right, slippage. So that's why even looking at these, where there's traded, where there's liquidity, and where the prices are being executed relative to the markets is important as a trader for quality of execution. And we could see, come back here in the summary, and we could see here, well, the market price right now is 25 cents. And in theory, based on those historical stock moves, is 21 cents. So it looks already like there's some theoretical edge based on the historical benchmarks. And in addition, right, what we see is that the executions, are so far have been closer to that offer, to the asked price. Okay, so this becomes very important too, and maybe we want to just get, look for things that traded, let's say 100 or more. Right, so now if we were looking at multi-legs where there had to be at least 100 spreads, or not just stock, but actual put spreads that traded these put spreads, we could filter those out, and then, right, and then we could go and do that, best by theoretical edge, or something like this. So this again is helping us narrow it down to see, multiple factors of how to maybe improve our theoretical edge based on benchmarks and price executions. So we're combining all this into one screener. So another question that may also come up is, well, is there different ways to calculate these benchmarks? And yes, we could look at historical stock price distributions, how the stock moved. We could also look at how similar options were priced, right? So those are based on the implied volatilities of options. And for that, we could go here to historical IB. So the historical IB, this creates a benchmark for us based on the historical implied volatilities of similar options. So instead of stock moves, now we're looking at the benchmarks of the options values. So it could create another layer of potential edge, as confirmation. So let's say, for example, I'm going to come over here, and the theoretical, based on the IB, maybe we're looking for a positive here. So I'm going to go any positive. So you see now I have any. So these are option market prices that are on the higher end, okay, of the historical range. So these are spreads that are traded. The spread is on the higher end, 83rd, 71st percentile rank, 83rd percentile rank, and this is how much it is above the average based on the IB. So let's go back here. I'm going to come back here, and let's say we're looking for theoretical edge based, any positive here. So now we have both positive. So now we have two layers of positive edge. Okay, that's based on historical stock returns, based on the implied volatility. And on top of that, there are trades in these particular spreads today that we could go analyze and see where people were trading, right? So now we have this AMAT, the 210-205 put spread, right? So if we go to the volume analysis, we see, well, this traded 55 times today. Okay, there are 55 different trades today. We could go analyze those further, but I don't want to leave the screener. For a total volume of 5,420 contracts, average price of 75 cents, and we see the market here at 57.91. So it's a wide market, but it's trading in between those bids and offers, right, with the reference price of 219.44. The next one, ANET, that traded 1,212 contracts, traded 34 times today, for an average price of $1.27. You can see how wide that market is. So it's very, important insight, detail to see where those executions are happening relative to those bids and offers, and that there's actual trading interest. It helps with the price discovery process. And let me just come back here. I think we're coming up to almost I'll do a little bit more, but we're coming up to almost like, we have 20 minutes left, but we talked about the potential returns and the risks and returns. So if we go to the historical distribution here, right, what this is showing us, actually, let's go to strategy payouts here on this tab. So really quickly, what this does, and we could screen by it, it shows us the potential returns of this spread based on certain stock moves, right? So here, if the stock is down 1 standard deviation, okay, this spread will return a positive 9.9%. So it's pretty, you could see it's above, it's 221.19. The strikes are 205, 210. So even in 1 standard deviation move, this will be fine. It's making 9.9%. A 1 standard deviation move up 9.9%. And then we have all these other scenarios of, moves based on seasonality, moves based on average down moves versus average up moves. So here we also kind of get a quick analysis based on how the stock price moves. So let's just say if the stock moves down 1 standard deviation, right? So then you could see if there's positives, negatives, but if it moves down 1 standard deviation, I'm going to come here. And payoffs at expirations, payoffs at expiration. So a standard deviation move down. Let's say we still demand a 20% return. Let's see if we find any. Okay, nothing. Let's say 5%. All right. So here's certain spreads that we filtered out. Remember, we used 2 different benchmarks. We looked for spreads that were actually had activity, trading interest, and this also gives us some cushion because even if the stock moves down 1 standard deviation, these particular spreads still look like they would gain over 5% return, and because they are out of the money. Okay, so Jeff, I think I'm going to stop right there because we have like 20 minutes left, and I'll open it up for questions.
All right, yeah, sounds good. So one question we kind of got from some people just even before you answer it is they're asking if this is part of the ibkr platform. And it's not. We have an agreement with Market Chameleon where you can subscribe to them if you're our clients and get a discount. And you can see more information on that if you go to our website and go to pricing and research and news, and you'll see the Market Chameleon Square, and you can click on that and get more information just for the people asking. But Dimitri, the first question revolving around this is Randy's asking, are these out of the money spreads only? So I think what they mean is more like, is this something you would use for, out of the money strikes versus in the money and, so forth. So I think that's kind of
right. It's up to you because it's your particular outlook. Some people like out of the money spreads for the cushion. Some people don't mind in the money or at the money spreads. It depends on what your outlook is on the stock. If you think the stock has if you feel bullish and you have certain strikes, you think it's going to go above, and then the spread looks to you attractive, you could do any type of spread. So you don't have to do out of the money put spreads, it will really depend on your unique outlook at that time, right? So everybody has their own outlook, everybody has their own risk parameters and models of where they think the market may be going, or the stock may be going, or just that the spread looks good enough to take that risk, but you could do either way, at the money, in the money, out of the money. That would be, based on the trader.
All right, we got another question. It says, it sounds as if a set of criteria could be simultaneously established for short strike, delta yield, delta in yield. And they're asking if the yield is the same as hypothetical edge, win rate, and cushion.
Yeah, so I guess the yield, maybe we're looking at this, the yield if the stock is flat. So this would be the yield if, the stock did not, at expiration was at the same price, and it compares, well, if there's a positive or negative return, and then it compares it to the amount at risk. So that would be kind of like the yield, the amount at risk, so if you're risking $2 and to make $1, it's 50%, right? Return on your risk. So that would be the yield. These percentages, or your edge, is basically it's taking a benchmark and saying, well, if we took this benchmark, right, and this benchmark is based on the historical stock moves. So this one in particular is historical stock moves. And we use that as our theoretical value, right? Like, let's say that's what we wanted to start out with, our starting point. Well, if in theory that's our theoretical value and this is the market price, this would be the difference, the difference in edge. So that it would take the difference of this versus this divided by the amount at risk, right? So that's what your edges are kind of like, based on the amount at risk. So if you're getting an extra 5 cents and you're risking, something like 90 cents, so it's like 5.3%. So that's what this theoretical edge is kind of like how much, more or less, are you getting if we use that as the average benchmark relative to the amount at risk.
All right, and Alex is asking, are they able to save their screening criteria, Dimitri?
Yeah, so if let's say you came up with a screener that you liked, and that, these are the ones that you just want to save these criteria, because obviously the options are going to move around, stuff is going to move around. But if you like it, then just click on this, save new preset, right? So if you save it and say my new screener, whatever you want to call it, hit save. I'm not going to save, it'll show up here. So in your list, whatever your name is. So once you click it, it will set all these filters that you have saved, like I have now, and it will screen for you.
All right, and then Carlo's asking if it, and I don't know if this is really a way to really, I'm not really sure if you can answer this, to be honest with you, but basically asking if it's makes more sense to leg it. My response is, without giving any kind of trading advice, it sort of depends on what you're seeing. Like,
yeah, I mean, legging is just taking extra risk, right? Legging is taking extra risk where if you're not entering, so when you enter in an order where you require that both legs get filled simultaneously, right, or not, you're not taking that extra risk that if the stock goes against you, the other leg is going against you, right? So if you sell an option, if you're legging and you sell an option and the stock keeps going down, well, that option that you sold is going to be worth more, and the stock and then the option that you want to buy is going to be worth more, that you have to pay more. So by legging it, you're just taking now directional risk on the other leg, right? You're taking an extra risk by not doing them simultaneously. So the orders, the volumes that we filtered out would have been entered in as a multi-leg trade. So these over here, they represent that those orders were entered in not as a leg, but as a multi-leg trade. So they would have had to get executed as a multi-leg trade. So when you enter it in as a multi-leg trade, it's not going to get executed unless you have both options. It's not going to give you one option, and say, well, you didn't get filled on the other one. But by legging it, you're just taking an extra risk, which, if the market starts moving against you while you're getting filled, it could be pretty significant.
And Oscar's asking if, I think what he's really asking is, do you have a bear call spread scanner as well?
Yeah, so if you wanted to do the same thing with the bear spread, then just go under screeners up top and just do bear put spreads, bear call spreads, so similar. We just kind of concentrated on one of them today, but it'll be similar. It'll just be then, you're flipping it, you're buying the higher strike puts on the lower strike.
And let's see what else. Yeah, Matt is asking, saying historical win rates, going to be a key component of your screening process. How are you calculating those rates?
So yeah, so the historical win rates over here, to go through it, and here I'll open this up. So when we look at the historical win rate, we take this particular option and we say, okay, well, here are the strikes. We're looking at the 205, 210 strikes. The stock is 221.19, right? So the stock is above those options, right? And we look at 3 trading days to expiration. So then we look at it and we say, okay, well, if the stock goes below 205, this spread is worth $5, which is, it has to move below 7.3%. If this, for the option to, for both these options to expire worthless, and so you make the 45 cents, well, the stock has to stay above 210, which is, you have a 5.1% cushion or higher, right? So if it's unchanged, you're fine. If it's down 1%, you're fine. Down 2%, up 1%, 2. So stock has to be more than negative 5.1%, and then the in between is 7.3% to 5.1%. It'll be worth anywhere between 5 and 0. Well, now that we know this information, right? We know in 3 days how often did the stock move that it was higher than 5.1. More, it didn't go down by more than 5.1%, basically. That happened 88% of the time, right? That's part of the win rate. So you could see here, October 8th to October 13th, the stock was up 0.9%. Well, that means that both these options would be worth 0, right? Because they'd expire worthless. That's a win rate for you, because if both options are worth 0, you sold it for 45 cents. That's a great scenario for you. October 3rd to October 8th, the stock was unchanged. Both options would be worth 0. So you see, we're going through historically, looking at the different moves, right, and what the option would be worth. And if the option would be worth less than 45 cents, that's a win, right? So we're going through all these scenarios and then calculating the percentage of times. So this was 88% of the time. It was above here. In between, it happened 7% of the time. So in between, it could still be a win rate, right? Because it could be worth less than 45 cents. And then 4% of the time, it went down by enough to make it worth $5. So given all that, that's how we come up with the 89%, right? We're going through those scenarios, going through our data. I think this is going back 4 years. So you could change that actually here. 4 years of data, 2, 6, and if you want to manipulate that more, you could go to the option chain, and you could do more stuff from there. But this gives you a quick reference point, so that's where the historical theoretical win rate is. How often historically did it move given the same conditions? If there was earnings, this screener actually filters historical earnings moves and does the same thing. So filter out everything else and just look at earnings moves. Now for the IV theo, 71%. This looks at the implied volatilities. It's a little bit different. This looks at historically the implied volatilities of when you take a screenshot simultaneously, right? So you need to get what is this and this option worth simultaneously, right? The implied volatilities, and then say, okay, October 13th, this leg would have been 51.1, this leg would be 47.8. Based on that, these are the theoretical values, and the spread would be worth 51 cents. And it keeps going down the line. So this is taking a historical snapshot. And then we have all these theoretical values based on the IV, right? Based on just observing the options chain. And then it sorts it from highest to lowest, and it says, well, how many of these observations were below 45 cents, right? That was 71%, meaning that right now we're on a higher range of the historical implied volatility, historical valuation of the implied volatility.
And we got another one from Steve asking if you use GTC spread order, GTC meaning good till canceled, to exit the trades at your profit target.
I mean, that's more of like, a trading decision we don't get into. That's really up to the trader to decide when one is more appropriate than the other. I think if you put in a regular limit order, it's by default the day, right? I think like a regular limit order is just till end of day. I mean, GTC will last for longer than the day.
Yeah, I mean, for the listeners just that may not be aware, a day order will expire at the end of the trading day. A GTC, which stands for good till canceled, will go on depending on the system you're using. It could be like 30, 60, or 90 days, and obviously the option expiration as well. So like if it's a next week's expiration, the order's obviously going to either be filled or canceled after the expiration. It's not going to keep rolling. But
yeah,
that's just the difference for the listeners at home that may not be aware of the different type of time and force it's called,
right.
versus day versus good till cancel.
Yeah. Thing is, when you put in a GTC order, it's important not to forget you have it out there, because you might change your mind or forget about it, and then all of a sudden the market moves and you're like, oh, what is this? And you put it in a week ago, But I think by default, I mean, I'm not positive if it's everywhere, but usually like by default, things are like day orders, like a limit order, regular limit order. I think it's by defaulted by,
Yeah, I mean, with our platform, you can set your defaults. It might be with other platforms as well. So
yeah,
people can set their defaults whether they want it, what the time and force they want it to be, and then obviously always update it. But that is definitely a trading decision, and that is not, it's a decision the user has to make how they want to do it.
Right.
So that we got one last one. I think, Dimitri, we can fit in here. Glenn is asking, how much time elapses between when you receive market data and the end calculations, the implied value, the ranks are completed in general?
Yeah, so the market data is it's on a 15-minute delay. We take we take the market data, take the snapshot, and then run an analysis on that market data, which could take, depending on how busy things are, or how much market data is coming in, the intensity of the calculation. It could be 5 to 10 minutes, and there are certain um, to make it a little bit more efficient. Like, for example, certain securities that don't trade a lot will recalculate less often than something like that trades frequently, like Tesla or Nvidia. We do more frequent updates. Stocks that don't move around a lot and don't trade a lot, like this, the options are just sitting there, and so we try to do less updates, because you could have a stock that just kind of sits at $5 all day, and the options sit, at the same price. So those get refreshed less frequently.
All right, I think we're about out of time here and out of questions. So this was great, Dimitri. And again, for our listeners, you'll receive, if you registered, you'll receive an email later in the day with a link to this recording, whether or not you attended it just now. And then again, you can go on our website and find past webinars. And also, Dimitri, I believe for Market Community fans, you guys run a morning show on YouTube, I believe.
Yep. So every morning we have a show at 9 a.m. We talk about different option theories, strategies, tools, metrics, and that's at 9 a.m. in the morning. And if you follow us
Eastern
on
time for
YouTube, I
everyone.
think Eastern time. You can watch. You're welcome to watch, and there's also chats in there. Similar to this, where people can chat and ask questions.
Great, and I will see you, and I will in the podcast studio in a few hours. Until November, thanks a lot, Dimitri, and thank you for everyone who attended.
Thanks, Jeff. Thanks everyone for joining. Stay safe out there. Have a great trading day.